For the past, 3 years, the entire internet has been screaming at you, telling you to wait for the big real estate crash. Well, guess what? It's 2026, and something way more interesting happened instead. Yep, you heard me. While everybody else was staring at the horizon, waiting for the market to just fall off a cliff, a very specific, very data-driven opportunity quietly opened up. Now look, this isn't about hyper-speculation. It's about a fundamental shift in the market's DNA that the data is making crystal clear. Okay, hang on, I'm confused. Honestly, I feel totally paralyzed. I see news saying prices are way too high, but then my rent bill just keeps climbing. The old logic, right, was to just wait for the crash. It sounds like you're saying that whole idea was wrong?
It wasn't just wrong, it was a complete misreading of the data. The new math points to something we are calling the golden window. This is a unique period where the market isn't crashing, but it's not soaring either. And it's right there, in that stability, that we find all the opportunity.
And today, we're going to break down exactly how you can use it. We're starting with a new art of negotiation that puts all the power back in your hands. We're also going to cover a secret loan that basically unlocks the market for freelancers. And yeah, even a method for investing with what might be in your checking account, like right now. So, it all starts with understanding why this flat market is so incredibly powerful. You got to forget the wild, volatile swings of the past few years. The key to building wealth in 2026 isn't chaos, it's stability. So let's look at the 3 core numbers that really define this golden window. The first number is a big one, 0. For the first time in what feels like forever, national home price growth has completely stalled out. We're talking JP Morgan, the National Association of Realtors, they're all projecting growth somewhere between 0 and maybe 2%. Now, investors used to hear flat market and run for the hills, but that's old logic. Today, this stability is the bedrock of our entire strategy. Okay, factor number 2, inventory. While prices are flat, the number of homes actually for sale is up a whopping 20% from last year. More choices mean less competition. It's that simple. The days of those insane bidding wars and people waiving inspections, they're over. You, the buyer, you finally have some real leverage. And here it is, the final piece of this puzzle, mortgage rates. Now, they're not at those crazy historic lows, but they have settled at their most favorable point since 2022. So let's recap. Prices are stable, inventory's high, and the cost of borrowing is down. Okay, I get it. The numbers make sense on a slide. But what does this actually mean for me? If I'm trying to buy a house this year, how do I actually use this information? It means you stop being a price taker and you become a price maker. This brings us to method 1, negotiation alpha. See, when sellers can't just sit back and rely on runaway price growth to sell their home, the entire power dynamic flips on its head. Think of it like this. The last few years were like trying to buy a pair of limited edition sneakers online with 100,000 other people. Total chaos. Today, it's like you're shopping at a secret sale and you're one of the only customers in the store. You can take your time, you can really inspect the goods, and most importantly, you can negotiate. And this is where you get really strategic. Don't just haggle over the sticker price. You need to demand concessions. Ask the seller to cover your closing costs. Or even better, ask them to fund what's called a 2-1 rate buy-down. That's where they prepay some of your interest to slash your rate for the first 2 years. This move alone can save you hundreds of dollars a month. That is negotiation alpha. That makes a ton of sense if you have a nice, stable W-2 job. But what about the rest of us? I mean, seriously, how does a YouTuber or a freelance designer or literally anyone with 1099 income get a loan? Traditional banks take one look at our tax returns with all the write-offs and just laugh. They say no. That is a fantastic question, and it leads us right into the second method for 2026. This, my friend, is the year of the DSCR loan. It stands for Debt Service Coverage Ratio, and it's brilliant because it completely sidesteps that whole problem of personal income verification. The logic behind it is incredibly simple, almost elegant. The lender doesn't look at your tax returns. They could not care less about your W-2. They ask one and only one question. Will the potential rent from this property cover the total mortgage payment? If the math works and the answer is yes, you can get the loan. Period. And here is why this is the perfect tool for right now. The magic number for most lenders is a ratio of 1.2. All that means is the rent needs to be about 20% higher than the mortgage payment. With home prices flat and rents holding pretty steady, finding properties that actually meet this ratio is more doable now than it has been in probably a decade. This is the key that unlocks real wealth for the entire gig economy. Okay, I'm following you. But whenever I think about real estate investing, my mind goes straight to buying some rundown house and fixing it up. And to be honest, that sounds like an absolute nightmare. Like, you never know if you're going to find mold hiding in the walls or if the foundation is secretly cracked. The risk just feels huge. You are absolutely right to be skeptical of that model. The old fixer-upper game is super high risk and comes with wildly unpredictable costs. The 2026 logic is different. It's smarter. It focuses on the massive renter nation that's been created by this affordability crisis. So the goal isn't a quick, risky flip. It's providing high-quality, low-maintenance housing through new build-to-rent communities. I mean, just look at the comparison. It's stark. A traditional fixer-upper comes with high, completely unpredictable maintenance costs. But these new build-to-rent communities, we're talking low, predictable costs. They also attract higher quality tenants and are projected to have a much more stable, reliable return on investment in this market. The math is just undeniable. This is all great stuff, but man, it still feels like it's for people who already have money. DSCR loans, down payments, I mean, seriously, who has $50,000 just sitting around for a down payment in 2026? It feels like the biggest barrier to entry is still just the cash. That is the single most common question we get. And that is why our bonus method is maybe the most important one of all. The logic of fractional ownership has finally gone mainstream. And look, this is not some crypto scheme. This is a fully regulated way to buy actual shares of income-producing rental properties. The whole process couldn't be simpler. You sign up on a regulated platform, you buy shares in a professionally managed rental property for as little as $100, and you start earning income. You get the cash flow, you get the tax benefits, and you get it all without ever getting a 3 a.m. phone call about a broken toilet. It is the genuine democratization of real estate wealth. So ultimately, this all comes down to reframing our goals. The get-rich-quick, speculative mania of the past few years, it's over. The 2026 market rewards the logical investor. It's about finding that stability, acquiring a good asset at a fair price, and generating long-term, predictable yield. We've laid out the data. We've laid out the strategies that work inside this golden window. A flat market with high inventory isn't a crisis. It is a rare moment of clarity and a massive opportunity. The math is clear. So the only question left is, what will your next logical move be?